Okay, so let's get into the money spin growth strategy, right? As I told you, this is proprietary. I worked on it myself, and over a period of time, while I was gaining other income sources, I wanted to create some of my own to compound it in the right fashion. Now, please also understand, I have been using third parties. That means for example, if I talk about mutual fund in this case, or some other assets that I talk about in terms of debt, I've built those relationships, I've built certain kind of capabilities, and knowing the right person, right, who can do this and replicate what my thinking was over a period of time. Okay, in case you already have these kind of resources, that what I mean is your banking, your deposits, or your debt creating activities, or maybe a mutual fund or an ETF kind of your financial advisors. Please live with them, discuss this with them, and then manage that accordingly. Because please understand, I am not a financial advisor. This is what worked for me in my criteria and my scheme of things, right? And I'm sharing with you so that you can assimilate what you best get out of this. You can do it stepwise and do the same thing. You won't get different results, right? Because we live in the same world, okay? But when you go country-wise, so this could be very specific to maybe India, right? But in US, if I go details of US, there is ETFs out there, right, which I use instead of mutual funds, for example. The interest rates are different than what is being shown on the screen. Then your criteria for other debt borrowing, etc., is again different than what again has been shown, right? So that result might vary based on the nation, based on your environment, your criteria, and so on and so forth. But the larger goal still remains as principles, and they are as follows. Number one, we're going to use the capital that you've accumulated over a period of time, and I'm calling it capital because the earned income over a period of time, once you use it for your expansion of income, right? So it becomes a capital because you install it once and you don't look into it again. All right, that's the way it works. So that is a capital because now you're thinking of this as a business for compounding your your growth in terms of your earned growth, and these can be then termed as financial assets, which are then multiplied to give you the outcome that you're looking at. Okay, in my case, that outcome was over 500% and growing with time, and it compounds much higher towards the end. Okay, once you meet your criteria of the years that you want to look into. With that said, as I explained in the previous one, right? The assets will be the capital deployed can be used as financial asset. That asset will result into some interest. Against that interest, you take some debt. Against that debt, you use to multiply using other financial instruments to start the compounding effect. That's the basic principles behind this. Now, with all these coming into play, right? Add to this the other elements of passive income, right? For example, your equity portfolio, for example, your mutual fund portfolio, right? Or your tradable, or that means you're a little active, I would say not active, but passively active, if you will, for your traded equity, right? Which we'll go through in detail how simply you can do that by just putting some 15 to 20 minutes in a week or a day, depending on how you want to go about this. That will result into additional cumulative kind of an outcome. All right. And once I go from a practical standpoint to make you understand how that works, you will get an inkling or justification of what I'm talking about. Okay. With that said, let me take you to an Excel sheet which has been devised specifically for Rise 4 based on my specific inputs that I started from some point of time. The number that I put might not be exact, that from a capital standpoint could be a little more, but the criteria that I mentioned is as per we are in 2022-23. Okay, so from that point of view, let's jump into it. And if you can see my screen, okay, what we have is a simple table, if you will, right? This consists of certain assumptions on the top end. That means the row 2 and 3 are assumptions. Okay, the way the sheet works after you download is the highlighted orange areas are the ones that you can change. Okay, now if you see, this one is actually a culmination coming from K. Okay, don't get bothered right now, just hold on with me. once I go serially with each, you get a better understanding. But try to understand now what is happening. I'll take you through discrete steps. Number one, there is a capital employed, right? This is the number. Before I jump to number into the number directly, please understand these cells are now locked. Okay, why? Because if you change one, the entire chart might change and might all help your purpose. Hence, the highlighted parts are the ones only that can be changed. Clear? With that said, let me start. Right, number one, you have to see the capital you deploy. Now, I put about 2.5 million. Now, this could be any currency. Okay, this could be Indian currency, it could be euros, it could be dollars, GBPs or whatever that is out there on AUD or CAD and so on and so forth. So any nation, any country, this is applicable if you change the orange criteria depending on the country. Okay, it equally holds good. So with that said, if there's a deployment of, say, since we're talking to the Indian scenario, let's talk about, say, 25 lakh rupees has been deployed as capital. Okay, in the current returns on fixed deposits. So this column, the C column, is the fixed deposit column, right? You see on the top the fixed deposit return. The 5% on the top is the at least you will get. Okay, there is more of course, but this is at least you can get from a fixed deposit return. Okay, and these are from a revenue sources perspective, right? So this is not justified for income tax, because that has different criteria, because if you're running a business, you can manage things accordingly and so on and so forth. If you're employed, it again can be looked at in a more discrete fashion, where your taxation laws can be subjugated to get to a point where this gives you a return of 5%. So that's keeping that in mind. With that said, the returns on 25 lakh for after a year could be the number that you see. Okay, that is how to read this. Number two, now once you put a fixed deposit of this orange 22.5 million or 25 lakh rupees, right, that can fetch you with a decent bank at least 80% of a FD borrowing, which is called an overdraft in this case. All of us will be familiar if we are the business guys or the entrepreneurs or whoever we are. So this can be used from an overdraft perspective, which is nothing but your debt. All right, I used it. So this is what I did. So I got a 20 lakh kind of a debt against my fixed deposit. Why I did that? Because if I put certain amount here, that amount is secured. Okay, that 25 lakh secured from a large perspective, right? Because fixed deposit comparatively is risk-free and all that, or minimized with risk unless the bank goes kaput. Okay, so with that sense, and for the Indian folks, you should also know that the liability a bank carries against your fixed deposit is roughly about 3 lakh till the time I was talking about it, and it can change with time. Okay, so they will not really, if they go kaput, they bankrupt, they might just give you that certain amount, which is the criteria as per law, the tax laws, or rather the governmental laws. So that aside, right, let's focus on the key numbers, because mitigating that aspect of things has different criteria. Okay, but knowing the Indian systems, right, no bank has been let down, right, and they've again been sprucing up at the right time if something like this happens. So now in this case, I'm talking about the top-notch banks where something like this can't even be thought of. Okay, your HDFCs, ICS and Kotaks of the world, right? So use those. So with that said, you get a borrowings of 20 lakhs, which then you start either a SIP, which is a systematic investment plan towards mutual funds. And we will talk about how to choose a mutual fund in case you want to do it on your own, okay, with key steps and how to do this and key ratios that you should be looking at, with a practical example, through various platforms, how you can do this. Or if you already are investing in mutual fund through certain third party, financial advisor and other criterias, you can continue doing that. But what I'm showing you is the process of doing this, okay, what worked for me. So with that said, if you have a criteria that you borrowed at 80%, that you can put to use with at least an absolute 13% return. And why I'm saying absolute, right? A typical long-term mutual fund, long-term typically means 3 years and above, is where you can get at least 15% compounded return, right? A CAGR of sorts. Now, because you borrow, that means you take a debt comes at a 2% kind of an interest from the bank. What does that mean? Suppose you are getting 5% fixed deposit interest from the bank, and if you take a overdraft, that is your debt, you need to give them 2% for the borrowed money. All right. So while your fixed deposit is going at a rate of 5%, your borrowing is at kind of 2% from the fixed deposit. Okay. Clear? Now, with that said, the calculations are then taken henceforth, right? So fixed deposit at 5%, your borrowing coming at about 2%, right? Then for the 80%, mind you, it's not the whole amount, it's 80%, 2% is the borrowing interest that you give to the bank. And then you have your average return from a long-term perspective from mutual fund at 15%. Hence, the effective mutual fund return would be roughly 13%, right? That's the reason of putting this 13% here. Clear? OD at 80%, borrowing of FD at 5%, 2% that is the net return from the FD, and resulting into so much. Are we clear? Okay, with that said, what happens? So now you do this for 20 years, you keep on doing this. If you see there is a 25 lakh, you got a return at 5%, which now comes here, right? In line 2, arrow 2, if you see my arrow, my cursor. Now you are at 2.62 million, right? Which then compounds next year with a 5% return at about 2.75, and so on and so forth. So this continues down until you have about 66 lakhs from the 25 lakhs at the end of 20 years. Clear? Now let's see what's happening on the amount that you borrowed, right? And you're getting a return of 13% year on year from your mutual fund or an ETF or whatever that criteria that you used to do, right? These are the normal terms typically in the marketplace. But if you think it is less or more, you please change your criteria and see, because this is what has happened to me. So with that said, 20 lakh borrowing becomes with 13% about 2.2 million, 2.25 million odd, and then that continues down. Okay. Now if you see this box, it's been colored differently, and I'll come to that. But for a general criteria perspective, it is as much as turning into, the 20 lakh is now turning into some 96 lakhs, that is 9.6 million. Okay. So a capital, your FD is now become 6.6 million, and your roughly your return from mutual fund is about 9.6 million. So your total is at about 1.3 million odd, right? That's what it is. And with this, you return the original principal amount, suppose at the end of 20 years that you borrowed. Remember, you borrowed 20 lakh rupees for your OD. You return that. So that way, fair and square. Okay. And the remaining amount is as you see, which is roughly about 513%. Okay. These will change once you change. So suppose you now become, your average return from mutual fund you see is only 12%, not 15%. Everything changes. Your return is 372%. So it's important to find the instruments. Hence, once we go to mutual fund, the churn, right, the changes are very important. So your threshold of 15% is maintained so that you get the best returns. Okay. Of course, you can go above 15% and all that. That's pure play, how the economy does and various other factors coming to existence. But this is what you should be looking at. So for argument's sake, I'm just keeping it what worked for me so that we are clear. Right. Now, this is one end of the money spending strat for your compounding activity. What you can do further with this, right? Now, once you put, and you spend about 4 years, and I'm coming to this area of E9, if you will, of the Excel sheet, which is the row number 4 from a Excel sheet perspective. That is after 4 years of operations, you see this is working smooth for you. Now I go to the next level. That means I borrow this money, right? How do I borrow it is very important. I start something called an SWP. That is a systematic withdrawal plan. So please understand, I'm going at a rate of about roughly 15%. Against that, I am taking a 6% back from the mutual fund on an annuity basis, right? You're compounding at 15% for 4 years. Now at the end of 4 years, I am asking the mutual fund companies to now give me a withdrawal plan. That means systematically every year give me 6% return. I can take that in form of quarterly, half yearly, and things like that. So assuming by the end of the 5th year or the 4th year, you start that activity and you get against this amount of 28,85,794, which is compounded over through mutual funds over 4 years period of time. I ask them to give me a SWP with 6% of my annuity amount. So with that number at 6% comes at the end of that 4th year about 1,73,148. Okay. Now this is the one which becomes now capital for our stock activities. Either we do short-term trading, we create a portfolio out of this for a long-term perspective, which then generates wealth accordingly, or whatever we do. Now what I did, I segregated the amount, right, initially by putting and creating a portfolio of my larger stocks for a very long time, roughly, and I continue, right? I might not use it, I might not come out of them at all. So those are the long-term portfolios for me, right? Which compound at much higher rate, cannot be even, suggested here. But I also did a portion of it and I started working on a trading element, because once I understood that it takes only so much of time, right, by the experts that I was working with and some of my mentors, and once I start demonstrating, you also understand why. So it takes about 15-20 minutes on a weekly basis. I sometimes do it daily, right? So that's why, weekly can be a little, I work on the weekends on this, and then on a daily basis, I do something for 10-15 minutes. And you'll understand what those means. Then what that results into is at least 5% of return on a monthly basis for me with the cycles that I run. Okay. And in your case, if you go a little more deeper into it, you can run much higher cycles for getting the return, right? Because once you see the simplicity of this, you might want to jump into it, and you might be able to jump into it in case you want to, whatever the criteria. So once you run those cycles, right? So the first year, after it's starting on the 5th year, if you realize, right? So this is here. At the end of the 4th year you got, 5th year you start your activity from say maybe the first month itself. Then you start getting by virtue of running these cycles at 5% per month, you get certain amount, right? So that amount is roughly about 1,74,000 odd, right? You make out of this because you're compounding at that rate. So the new amount plus the capital that is deployed will result into this number. Okay. And if you want to see the formula, you can always unprotect the sheet and do it. And the passwords are given below. But in case you want to see what is going on in this, right? Let's see if there is a formula that I can show you. Okay. So, okay, I have to uncover the sheet. So let me try to do that and help you understand how this works. Okay. So now we have opened that up. Now if you see what the formula is, we are just adding the original amount with the amount which is accrued over that year in the 5th year, because we took in the 4th year we took an amount, and for the rest of the years we did this compounding of getting a 5% return in the stock as in the stock investments with 5% per month. Now this is largely from a stock trading perspective. Okay, portfolio resides to B, and that I used to do on a periodic basis, maybe taking some amount of here. Now assume that is happening and that grows fast. I mean that over a period of time it accumulates very fast. Okay, so but from a demonstration perspective, what we have done is we've taken an amount and we've compounded it using at 5% per month, which is resulting into a number which is shown here. Okay, with the cycles which I run, and I'll show you those cycles. So with this said, once you get these kind of returns, what this means is by end of, and you keep on doing this repeatedly, right? You get this amount now as your next year, that like 1,82,268. You churn this about from the 5th year perspective. In the 6th year you get so much amount. Now you add to your portfolio, and then rather your portfolio of stocks, etc. And for me, at the end of the 4th or 5th year, I started building up my portfolio, right? The large portfolio I talk about, which is fill in and kind of forget it types. So it was not giving me high returns like my stock activity was, but over a period of time, it started giving me multiple, right? The exponential perspective. So that's what happens. And criteria to do that is also what you're going to discuss from a practical standpoint, right? With that said, end of the 20th year, you see if you started with 1 lakh and other numbers and so on and so forth. Now it's returned about 12,42,000, where you started from 1 lakh rupees odd from here, end of 4th year. So in 16 years, with these compounding activities, you now add about 12 lakhs, right? So now your current return by virtue in this whole exercise is this amount, that is 1 crore 28 lakh 67,712, right? Or 12 million Indian rupees, is now resulting into 14 million rupees, or 1 crore 40 lakhs in Indian rupees, which is a return of roughly 563%, okay, resulting into a 28% year-on-year growth, right? So this is what, in a nutshell, a money spin kind of strategy is. As I told you, this is good for download. This is what specifically worked with those criteria that I mentioned to you, right? And as we speak, I am reiterating the cycle, right? Because I have other objectives in mind. And with one cycle, I will have now started putting things again as a supplementary income into larger mutual funds, because I get a little less time compared to the others, and my mutual fund kind of financial advisor is managing that for me with my criteria mentioned to him over a period of time. So those guys are very clear what to do. All right. So this is a clear picture of what happens during a money spin element of activities. I named it, I christened it myself to money spin, and has been kind of put in a tabular format. And these could be almost actual returns if I put my real numbers in. Okay. So the very purpose of being a little not so as open I'm supposed to be, I'm putting a definitive number of the 25 lakh rupees or 2.5 million Indian rupees. So this can be kind of customized and used the way you feel is right, and use it to the extent that you want to, and also be modular, right? You might not go to the extent of getting into stock mode, etc., if there's no willingness, right? But again, let me give a kind of a year of precaution here. Stock activities or equity activities come from passion, right? I was very passionate. Number one. Number two, requires patience. I am patient, all right? Unless you are not, please outsource this to someone. Number three, perseverance, right? You'll go through troughs, that's okay, but once it comes up, it goes like rapidly up, all right? So be patient and perseverant at the same time, right? And keep faith. Now, besides this, if you realize this whole criteria is about being as disciplined as you can, right? Each day, each month, each week, how you have to look into things. And we're going to we'll get deeper into it once we get into the S and T and U column, how we use stocks and mutual funds to do these things. All right. Now, with that said, if you have any questions about this after you download and you look into this in a more discrete fashion in your kind of scheme of activities, you can always bring it out to me during the RISE circles. Okay, and those will be very highly practical sessions where we go deeper into some of the criteria that have been mentioned through. Okay, now let's jump back to where we were. And with that said, I pretty much covered the money spin growth strategy. And with that, the challenge comes into play. And this is what you need to do before you come to a RISE circle. Otherwise, your RISE circle will not be of any meaning. So download the Excel sheet I showed you from the link below. Put the criteria of your details in your nation, in your country, as per your specific sphere of things that you're working in. And then based on that, once you get an outcome, right? All these could be further managed in a particular way, right? Once you finish RISE, you'll understand that better. But once you bring such queries to RISE circles, your answer can be specific to you, to your purpose, which others can also benefit once you get the answer for. And with that said, please also understand, do a recheck as per the nation. I told you, right? It's different in UK because that's what I've seen. It is very different in US, right? Southeast Asian countries are again different, and so on and so forth, right? So depending on where you are from and what you're doing, please make those criteria and recheck them before you start putting your details in, so that you're very clear and have a kind of a predictive outcome out of this, rather than jumping into things because it happened to somebody. Clear? With that, I will see you in the next one, right, where we cover now the details of all the elements of the money spin growth strategy that we talked about. Okay, I'll see you there in a minute. Bye.